Hello students, this is Professor Vincent Osaya. Welcome to my class, and this is part 3 of chapter 1 presentation. Chapter 1, accounting and the business environment. Let's take a look at objective 4. We are going to use the accounting equation to analyze transactions. So let's stop right there. Recall, we talked about accounting equation. Assets equals to liabilities plus equity. That is the accounting equation. So we are going to use that accounting equation to analyze transactions. What are transactions? We said that a transaction is an event whereby an exchange takes place. What does that mean? A company goes to Best Buy to buy a computer for $1,000, give Best Buy $1,000 and receive a computer. That's a transaction. So on a daily basis, companies engage in several business transactions between them and the customers, vendors, employees, and other third parties. So here we are going to analyze those transactions. What does that mean? In other words, we are going to determine the impact those transactions have on the accounting equation, okay, or on the elements of the accounting equation. So, and we are going to do that, and we are going to use the accounting equation as a basis. So, like you say, any event that affects the financial position of the business can be measured with faithful representation. It's a transaction. So we just talked about that. And look at what is not a transaction. Look at hiring a new employee. When we hire a new employee today, there is no transaction. At the end of the week, assuming that we pay weekly and the employee has already done what he or she is supposed to do, there's a transaction because we are not obligated to pay the employee. So we need to have an understanding of that. So that is part of the analysis. So moving along, let's take a look at, let's analyze and record this transaction. Look at number 1, owner's contribution. Like we said, the owner contributes money into the company. So what does the company receive? Cash. And the company has to give something in return. And the company gives stock to the owner. The company has to record this transaction. And we are going to use the accounting equation as a format or as a layout. So look at what the company did. Cash, the company said $30,000 on the left side of the equation. On the right side of the equation, the company had what you call contributed capital. Remember we talked about contributed capital, owner's contributions, owner's investment into the company, and we have the title. Look at the title of this account here. We call it a common stock trading. So on the left side, we have cash 30,000, we have common stock 30,000. So the accounting equation is a balance. Anytime we record a transaction, the accounting equation will always be in balance. Of course, equation meaning equal, all right? So moving along, let's take a look at transaction 2. The company purchased land for cash. So what happened? You have to imagine that you are actually involved in this transaction. You really have to picture this transaction actually going. So what happened here? The company gave $20,000 cash or check to whomever, and the company received a piece of land. So what happened? We are not analyzing it and having an impact. Our cash just went down. So we have $20,000 less cash. But what happens? We receive what? Land, a piece of land. What is land? Obviously, land is an asset. So an asset, land specifically goes up by 20,000. So interestingly, look at what happened here. This transaction affected only cash. One type of cash went down, that is cash. Another type of asset goes up, and that is land. So clearly, the accounting equation is in balance after that transaction. So let's take a look at the third transaction. Purchase of office supplies on account. This is big. You need to call this. On account. Another word for this is on credit. You need to catch this. This is on your exam. These two words are used interchangeably. On account, on credit. Same thing. Meaning, we purchase office supplies without paying the vendor. So how do we record that? On one hand, we receive $500 worth of supplies. Supplies is an asset. On the other hand, we are obligated, or the company is indebted to the vendor, office man or whomever. So on this side of the equation, 500, our obligation or debt goes up. So one side of the equation went up, another side of the equation also went up. Of course, the accounting equation will be in balance. Let's take a look at transaction 4. Earning of service revenue for cash. This is very important. So what happened here? Here, the company provided service worth $5,500 and they received cash for it. So what happened? That you have to zero in on the easier or the easiest of the impact. So clearly the company received $500 cash. Cash went up by $5,500. Then what has happened? Equity. Remember we talked about service revenue being part of equity, and that is $5,500. So our equity went up and our cash went up. So the two sides of the accounting equation are the two sides of the accounting equation is the balance. One account goes up here, one account goes up here, so the equation is in balance. Let's take a look at this. This is very important. You need to catch this. Look at this. Here, the company earned service revenue account. Aha! Look at. Before, we bought supplies on account. Now, we are providing service on credit. The table has been reversed. We bought something from a vendor on credit or on account. We didn't pay. Yeah, a customer came in and we provided services to the customer without the customer paying us. So now we provided services on account. Now, you need to catch this. What happened here? Obviously, anytime we provide service or sell goods to customers during the course of doing what we are doing, we say that is revenue. So specifically, we call this service revenue. So our service revenue went up. We generated more revenue.